State income tax. What are reciprocal agreements? Imagine crossing a state line for work and wondering if you need to pay taxes twice. It can be confusing, but there is a way to make it simpler. That's where reciprocal agreements come in. These agreements are legal arrangements between states that help workers avoid paying taxes twice on the same income. If you live in one state but work in another, these agreements let you pay income tax only to your state of residence. This means you do not have to file a non-resident tax return in the state where you work. It makes tax filing easier and helps prevent paying more than you owe. Remember, these agreements only cover state income taxes, not federal taxes or other taxes like sales tax or property tax. They are designed to help people who regularly cross state borders for work. There are two main types of these agreements. The first is bilateral, which are formal agreements between two states. For example, if you live in Maryland and work in Pennsylvania, you only pay Maryland state income tax because those two states have a bilateral agreement. The second type is unilateral, where one state decides to exempt its residents from paying taxes in another state if that state offers similar treatment. States like Indiana, Minnesota, and Wisconsin have such agreements. To benefit from these agreements, you usually need to fill out an exemption form with your employer in the work state. This stops taxes from being withheld in the work state and ensures you only pay in your home state. If taxes are mistakenly withheld by the work state, you can file for a refund from that state and report the income on your resident state tax return. For Asian American taxpayers who live in one state but work in another, especially near state borders, understanding these agreements can save money and reduce the hassle of filing multiple tax returns. It's important to check if your states have a reciprocal agreement and to complete the necessary forms. That way, you avoid overpaying and keep your tax process simple. To sum up, reciprocal agreements prevent double taxation, make filing easier, and requiring employees to submit exemption forms. They can be bilateral or unilateral, depending on the states involved. Knowing about these agreements can help you save time and money when managing your state income taxes.